The price action we are witnessing at $88,000 is flashing a signal that most retail investors are completely ignoring. While the mainstream media headlines are celebrating new all-time highs, the on-chain data suggests a massive divergence between price and momentum. We are seeing a significant amount of distribution from wallets that have held Bitcoin for more than 3 years. This suggests that while the crowd is euphoric, the smart money is using this liquidity to offload risk. If you are currently holding Bitcoin or considering entering a leveraged position, you are standing on very fragile ground. The market is currently deciding between a catastrophic correction that resets the cycle or a parabolic run toward $200,000. Understanding the difference between a cycle top and a bear trap is the only thing that will protect your capital in the coming weeks. In this video, I will present the institutional evidence regarding the $88,000 level. I will show you exactly why this price point is acting as a critical pivot for the entire asset class. We will look at the realized price of short-term holders to determine if we are overheating. Let us get into the weeds. The first metric we need to dissect is the behavior of the spot order books across major exchanges. When Bitcoin approaches a psychological level like $88,000, we typically expect to see a wall of sell orders. However, the current data shows that the sell-side liquidity is surprisingly thin compared to historical tops. This is an anomaly that requires our immediate attention. In previous cycle tops, such as the peak at $69,000, we saw a massive influx of coins moving onto exchanges. Today, we are seeing the opposite trend. The 30-day moving average for exchange inflows has hit a 3-year low. This means that despite the high price, large entities are not rushing to sell their Bitcoin. They are holding, and in many cases, they are moving assets into cold storage. This behavior contradicts the thesis that $88,000 is the absolute cycle top. If this were the end of the bull market, we would see a rush for the exit door. Instead, we are seeing a supply shock that is becoming more severe by the day. However, we must balance this bullish supply data with the reality of the derivatives market. The funding rates for perpetual futures contracts have reached levels that are unsustainable in the short term. When the cost to hold a long position becomes this expensive, the market is incentivized to flush out the leverage. This is where the concept of the bear trap comes into play. A bear trap occurs when the price drops sharply, convincing traders that the trend has reversed, only to aggressively reclaim the highs. At $88,000, the market is primed for a liquidation cascade. If we see a rapid drop to the $75,000 region, it would likely liquidate billions of dollars in long positions. This flush is exactly what institutional investors are waiting for. They need to buy back into the market at a discount, and they need your panic selling to fill their orders. The reality is that institutions do not buy at the top of the candle. They buy into the liquidity provided by stop losses. This is why looking at the funding rates is crucial right now. If you are finding value in this deep dive into market mechanics, consider subscribing to ensure you do not miss our future updates. Now, let us look at the comparison to the 2020 cycle. In late 2020, Bitcoin broke its previous all-time high and entered a period of price discovery. During that phase, we saw multiple corrections ranging from 20 to 30%. Each of those corrections was labeled as a cycle top by the fearful crowd. Yet, each correction was simply a consolidation period that allowed the market to build energy for the next leg up. The current structure at $88,000 mirrors the consolidation we saw before the run to $60,000. We are seeing a transfer of wealth from impatient hands to patient hands. The realized cap, which measures the average price at which every Bitcoin last moved, is trending upward. This indicates that the floor price of Bitcoin is rising, creating a higher support level for the entire network. Another critical factor is the activity of the spot exchange-traded funds. The introduction of exchange-traded funds has fundamentally altered the market structure of Bitcoin. These funds create a persistent bid that was not present in previous cycles. Even when retail interest wanes, the passive inflows from these funds continue to absorb the daily issuance from miners. Speaking of miners, we must address the hash rate and miner profitability. At $88,000, miners are extremely profitable, which usually leads to them selling some of their holdings to cover operational costs and upgrade hardware. However, miner balances have remained relatively flat over the last quarter. This suggests that miners are speculating on much higher prices. They're not selling at $88,000 because their models project a price target closer to $200,000. This alignment between miners and institutional holders is a powerful signal. It suggests that the supply side of the equation is locked down. The only variable left is demand, and demand is being driven by global liquidity cycles. We are entering a phase where central banks around the world are beginning to cut interest rates. As the cost of capital decreases, liquidity flows into risk assets. Bitcoin is the most sensitive asset to global liquidity conditions. Therefore, the macroeconomic tailwinds are supporting a move toward $200,000. Here's why this matters for your portfolio strategy. If you assume that $88,000 is the top, you risk selling your position right before the most explosive part of the cycle. Historically, the final leg of a Bitcoin bull market is the most violent and profitable. This is the phase where we see vertical price appreciation. However, this phase is always preceded by a shakeout. The market makers know that retail investors are emotional. They know that if they drop the price by 15%, most people will panic and sell. This is the psychological game being played right now. The chart is painting a picture of hesitation, but the on-chain data is painting a picture of accumulation. You must trust the data over your emotions. If this analysis is helping you separate signal from noise, make sure to like the video so we can keep providing this level of insight. Let us discuss the technical path to $200,000. Using Fibonacci extension levels, we can map out the potential trajectory of this cycle. If we measure from the bottom of the bear market to the previous all-time high, the 1.618 extension aligns perfectly with the $150,000 to $200,000 range. This technical confluence gives us a mathematical basis for the $200,000 target. It is not just a random number. It is a structural target based on market psychology and historical volatility. But the path there will not be a straight line. We are likely to see a period of high volatility where Bitcoin oscillates between $80,000 and $95,000. This range is designed to frustrate both bulls and bears. It is a meat grinder for leveraged traders. During this time, the dominance of Bitcoin relative to the rest of the cryptocurrency market is likely to remain high. Capital will flow into Bitcoin first as a safe haven within the crypto ecosystem. Only after Bitcoin breaks $100,000 will we likely see a rotation into Ethereum and other assets. Therefore, the strategy right now should be focused on accumulation during dips, rather than chasing green candles. The concept of the bear trap is essentially a liquidity sweep. If the price drops below $85,000, watch the volume. If we see high volume selling followed by an immediate recovery, that is your confirmation of a bear trap. That is the signal that the smart money has stepped in to defend the trend. Conversely, if we see a slow bleed with declining volume, that would be more concerning. But currently, the volume profile suggests that buyers are stepping in aggressively on every dip. The relative strength index on the weekly time frame is high, but it is not yet at the level seen during previous cycle peaks. In 2017 and 2021, the relative strength index pushed above 90. Currently, we are sitting in the 70 range. This implies that there is still plenty of room for the momentum to run before we hit a mathematical top. We are in the middle of the innings, not the end of the game. The fear of missing out, or FOMO, has not yet reached mania levels. When your taxi driver and your grandmother start asking you how to buy Bitcoin, that is the top. Right now, the general public is skeptical. They are waiting for a crash. This wall of worry is exactly what bull markets climb. As long as there is skepticism, the price can continue to rise. Once everyone is convinced that Bitcoin can only go up, that is when the top is in. At $88,000, we still have a healthy amount of skepticism in the market. This sentiment analysis is just as important as the technical analysis. So, is $88,000 the cycle top? The weight of the evidence says no. Is it a potential bear trap? Absolutely. The market is coiled and ready for a move that will liquidate over-leveraged participants. The probability of a sharp downside wick to clear out the order book is high. But that wick should be viewed as a buying opportunity, not a reason to exit the market. The structural fundamentals of the halving supply shock and the institutional demand shock have not yet fully played out. We are witnessing the convergence of these two powerful forces. The result will likely be a price discovery phase that shocks the world. $200,000 is not a guarantee, but it is the logical conclusion of the current supply and demand dynamics. Now, let us summarize the playbook for the coming weeks. First, do not use high leverage at these levels. The volatility will liquidate you. Second, if you are a long-term holder, ignore the noise and focus on the 4-year cycle structure. We are likely entering the final parabolic phase, which could last for another 6 to 12 months. Third, keep an eye on the exchange inflows. If we see a sudden spike in Bitcoin moving to exchanges, that will be our early warning signal to take profits. Until then, the trend is your friend. Be prepared for a drop to the mid-70s, but understand that this would likely be the final bear trap before the 6-figure breakout. The market rewards patience and punishes impulsiveness. Stay disciplined and stick to your plan. Disclaimer: I am not a financial advisor. The content provided in this video is for informational and educational purposes only. Bitcoin and cryptocurrency markets are highly volatile and carry a significant risk of loss. You should conduct your own due diligence and consult with a certified financial professional before making any investment decisions. Past performance is not indicative of future results. Trade safe, and I will see you on the next candle.